Investors are loving the 7% rally in the S&P 500 so far in November. Uncle Sam's also delighted to see inflation cooling off, interest rates coming down for treasury bonds for the last, few weeks. You're looking at Cathie Wood back on the Cartoon Network talking about the values of various different crypto assets, how she thinks Tesla is the best AI play for her. Personally, I look at this and I'm saying, we do not have enough key data points to say this should be a new high. I don't think this is a new bull market territory, despite these data points that we're looking at. Sure, you have seen this nice rally, over the last few weeks, but I don't think this is enough. And let me share some of the things that I'm looking at right now, both from a, what are the companies saying? What are the investors doing perspective? I'll also share how I'm personally investing in this environment right now. If you enjoy educational investment videos, you're watching Unrivaled Investing. So let's dive right into, things to think about, one of which is Walmart just yesterday sounding a note of caution on consumers ahead of the holidays. Well, what exactly did they say? Let's dive into this earnings call transcript. So I pull up AI Ticker Chat. I go, okay, let's select the latest earnings call. What insights does management have about the U.S. consumer? Because, the U.S. consumer, you're talking about consumption being around 70% of the U.S. economy. Walmart's the biggest or one of the biggest retailers. So you're going to get some great insights into how the U.S. consumer is doing. Let's ask. Let's ask AI to read this transcript, summarize it. First month is free at AI Ticker Chat. And it goes, management's key calls is that consumers are making trade-offs to afford the things they want, given the sustained high cost of things they need. And so that the consumer is feeling the pinch of economic pressure. There's still a high degree of variability. So sometimes, some weeks look great, but broadly seeing softening in the back half of October. So talking about economic weakness starting to emerge at the end of October. So, the holiday, the Halloween, that was still reasonably strong, a lot of candy sales. But what you're looking at is the consumer broadly started showing some weakness there. And I've heard this now from a couple of different data points that the economy could be starting to see signs of rolling over. So that would also help the inflation argument if you have, the economy cooling off significantly. You have Ray Dalio. What's he have to say? Managing one of the largest hedge funds out there, or at least the founder of one of the largest hedge funds out there. He's talking about how the U.S. is reaching an inflection point where the debt problem quickly gets even worse. Well, what's he talking about? I go to the central, the government budget office, central budget office, and the congressional budget office, CBO, and they're saying this is their figure. So this is the rosy scenario where they're saying, yeah, we're expected to go from around $25 trillion in debt to $45 trillion. So this is the U.S. government. And they're saying the average interest rate on the debt held is going to be around 3%. Now, this is a real problem because the actual cost of debt is now more than that. And there's a chance it goes even higher if Jerome Powell, let's say, hikes again. And so you might have a period where your interest costs are much higher than what the government's budgeting, in which case you're saying, well, how are we going to afford these interest payments? We're going to have to issue even more debt. And so then you start creating this spiral effect of who's actually going to buy those bonds. That's what Ray Dalio is concerned about is, you have $1.5–2 trillion annual deficit spending or annual deficits where you're saying who's going to keep buying these bonds? And that creates a concern, especially when you're assuming interest rates are actually going to be lower than they are right now. Cash currently yields between 4% and 5%. So why are they assuming 3% over the long term? How is famous investor Warren Buffett positioning himself right now? He's a net seller of stock to the tune of several $1 billion. When he reported his third quarter holdings, you could see he blew out of several positions, more of the cyclical names like General Motors. You could see he blew out of. Now, this is, I suspect, some of his lieutenants as well, trimming it. But broadly cutting it across, across the portfolio. He did find some very clever bets as he's been doing with international. So looking at effectively selling Japanese bonds, getting the yen, taking that currency and reinvesting it into low-priced trading houses in Japan that trade at low valuation multiples, let's say around 10 times, earnings. So if you could get a company that trades around 10 times earnings, returning most of that to shareholders via buybacks or dividends, maybe it doesn't grow that much, but it's generally tied to the economy, and then you're effectively borrowing at 2, 3, 4%, long dated with Japanese yen, you don't have to worry about the currency risk. You have this company that has global exposure So I just think it's another example of Buffett finding clever international cheap bets for him to make. This isn't for everybody because he's shorting the currency effectively, going long the individual stocks. What are my personal thoughts on how to invest right now? First of all, in full disclosure, this is not financial advice. Also, quick plug, I do expect a recession could happen in the next 1 to 2 years. If it does, my goal is to help my subscribers find potentially transformative investment opportunities. That's actually my personal background. Is during the great financial crisis, I was working at an investment bank where there were some really, in my opinion, not so great people. I'll leave it as that. And I was so grateful that you had this crisis where you could invest, where, I didn't want anything bad to happen to anybody, but having an opportunity to plow capital, deploy capital into wonderful bargains, it was a life-changing event for me. So my goal is to hopefully share some of the ideas I can find with my subscribers at unrivaledinvesting.com. It is a weekly letter, so if you're not seeing it, check your spam box. And, I'm looking for compelling ideas. I also share real-time portfolio updates. So once again, that's unrivaledinvesting.com. I think in the current investment environment, a lot of folks are still waking up to the fact that cash yielding 4.8% at Interactive Brokers, see the link below, this creates a real hurdle for investing. Because if you have a business that's effectively tied to GDP, maybe GDP plus, should it really trade at a premium to, let's say, 4 or 5% yield? So if you have the S&P 500 trading around 20 times, does it really make sense when you can be getting a cash yield? And keep in mind that 20 times is equivalent to a 5% shareholder yield. Does it really make sense when you can get cash around 4 to 5%? Personally, I don't think so. I think a lot of investors agree that, wait a second, if this cash yield is going to stick higher for longer, then you might have a reset in terms of valuations. Now, that gets down to you get a reset in the stock market, maybe you get a recession as well. And that's something I do suspect will happen. I think all the interest rate hikes of the last few years, they have yet to be fully felt by the economy. You've seen it in certain spots of the economy, like how activity in the home sector has completely, it's dried up, where people are saying, you know what, I don't really want to sell my house because I don't want to get into a new 8% mortgage and I'm locked in at 2%, so I'll just stick around. So I think you're just starting to feel the effects. It hasn't been fully felt by the economy, and you might be starting to see it roll over. So how am I personally investing? So I'm looking for toll booth types of companies. So no matter what happens, if there's a recession, if there's high inflation, no matter what plays out, I'm comfortable owning this. So it's not a cyclical auto manufacturer where it's a one-time sale. It's a recurring revenue type of business. And so as an example, I recently, a few weeks ago, and I called it out to my subscribers, I bought a stock that had sold off dramatically, over 50% in a matter of weeks, a company called Dalio. And so international payments company. It's effectively a financial toll booth, because they're making profits off of every transaction that they're enabling with their merchants. So my view is, as their merchants have more commerce over time, or if there's more inflation over time, they're going to get effectively that cut, a percentage or a fee for those transactions. Yes, it might get a little bit of a hit if there's a recession and there's less activity, but broadly, Dalio has shown that they are taking market share. You have PayPal, that's one payment, gateway, one payment processor. They're growing single digits. Dalio's saying, hey, we're going to grow 20 to 30%. You have a company that's founder-led, history of successful entrepreneurialism. This isn't their first company, a company generating lots of free cash flow. So that's what I'm looking for. Founder-led, strong cash balance sheet, toll booth type business model. Now, subsequently, the stock's up around 30-40% after they reported a favorable investor day, but I'm sharing this as a framework for how I'm personally looking at it. I'm not looking for the cyclicals that can get hurt significantly with a recession. I'm also not waiting for a recession. That's a key aspect. I sometimes get, feedback on this channel. Oh, Daniel, you're just waiting for a bottom. You're trying to bottom tech. That's not it at all. I'm trying to opportunistically look for great companies. If there's a recession, if there isn't a recession, I'm neutral either way. My view is, when I see something that's really compelling, that great company, great cash flow, strong balance sheet, strong growth, clearly taking market share, that's when I want to pounce. That's when I want to act. When I see something like that. I also do believe that a recession could be transformative for many people. I think you could see much lower valuations with a recession. Like if there's a recession next year, which I think a lot of people, are willing to say like, hey, I wouldn't put it at 100% chance that it doesn't happen. And so if you, unless you have that mindset that you're saying, hey, it's 100% chance that a recession won't happen next year, I'm certainly not putting that. But if you do have a recession, maybe it's a 10% chance, maybe it's a 30% chance, maybe it's a 50% plus, because you see the commentary from Wal-Mart CEO talking about the consumer, getting weaker, softer in the back half of October. I think you get that reset in valuations, in which case the S&P 500 is 15 times or lower, maybe closer to 12 times, in which case you're looking at much lower valuations and then even more opportunities for the aggressive investor. So do I think we have new highs here? I don't think we have what it takes at this point. I don't, the consumer, I don't believe is strong enough. I think the US government's going to have to reckon with their significant profligate spending at some point where they're going to have to say, okay, interest rates where they are, we're assuming 3%. It's currently 5%. That's a big difference. How are we going to sort of figure that out? I look at this and I'm thinking, I just don't see it. I don't see how you get a new sustained bull market, making new highs. There are spots that are great, like in artificial intelligence, where it's just really incredible the amount of progress. But broadly looking at the economy, I'm, especially with a weak consumer, especially with the US government, with these strong deficits and where interest rates are where they are, and also just cash creating that hurdle. Should the S&P 500 really go to a 25 times multiple, let's say, go to a 30 times multiple when cash is 4 to 5%? I don't think so. So you're automatically putting a cap on what the S&P 500 can do. So it's really driven by earnings growth. And are you going to get that when they're saying 70% of the economy via the consumer is weak? I just don't see it. I think this is choppy waters ahead, and investors should look at this and say, okay, let's find great companies and opportunistically purchase them, when you get these, when they sell off, when people are saying, oh, this is no longer a great company, and that it is. So I share my personal thoughts once again at unrivaledinvesting.com. I'd love to hear your feedback below in the comments. So thanks so much for tuning into Unrivaled Investing.